Hi, welcome to this very brief run through of leverage ratio analysis and assessing financial risk via ratio analysis. So what's coming up? This video includes a quick introduction to leverage ratio analysis, and then the formula, an example and explanation of the debt ratio, and then a formula and an example and an explanation of the times interest earn ratio. And then we'll wrap up with a review and a final warning. Okay, leverage ratio analysis. This is all about assessing financial risk. And the term leverage is related to the long-term liabilities and debt to the business. So it's not so much related to the short-term solvency issues of current liabilities, but more the long-term non-current liabilities or long-term debt to the business. And leverage ratio analysis can be useful for prospective creditors, prospective investors, or even managers themselves within the business. In general, you can assess the strain on the business from its long-term liabilities, and that includes gauging the level of future obligations of the business. You can assess the ability to repay all debts with today's assets, and you can also assess the ability to service the debt. So we're going to be covering two of the major leverage ratios. And I have to point out that there's a wide variety of leverage ratios available. And these are often guided by particular analyst preferences or particular industries. But we'll be covering two of the most popular and straightforward ratios out there. These are the debt ratio and the times interest earn ratio. These two ratios tell you quite a bit without too much complication behind it. Okay, let's get into it. The debt ratio, the first ratio we're looking at, the formula's there. It's just simply liabilities divided by assets, and I'll leave that formula up there. An example is if you have liabilities of $25,000, which is taken from the balance sheet, and assets of $80,000, which is also taken from the balance sheet. Plug those numbers in, and you have a debt ratio of 31.25%. Not too difficult. So the formula stays up. So what is the debt ratio telling us? It's telling us the proportion of assets that are financed by debt. In our case, it was 31.25. So it's the proportion of assets financed by debt. And that allows you to assess the financing strategy of your business. So whether they're funding most of the assets, either through debt itself or long-term liabilities, or whether they're financing the business through equity and retained earnings. You can also tell the general level of future cash obligations tied up in interest and principal repayments. So if there's a higher debt ratio, you can assume that for a longer period of time, there will be cash obligations related to interest or a larger principal repayment in the end. And also one of the key benefits is you can tell how comfortably all liabilities could be paid off if all assets were liquidated. So with our ratio of 32.5%, you could say it would take 32.5% of our assets, if we sold them all off, to pay off all of our debts. And what would be left over would be debt-free, so 100% minus 32.5. What's it, 32? No, it's 31.25. I beg your pardon. So just, you should rephrase that. Okay, our next ratio is the times interest earn ratio. And the formula is simply earnings before interest and tax divided by interest expense. And earnings before interest and tax is abbreviated to EBIT. So for our example, we have EBIT or earnings before interest and tax of $150,000. And interest expense of $3,500. And as you'll see, both of those data inputs are drawn from the income statement. So while the debt ratio drew data from the balance sheet, the times interest earn ratio draws data from the income statement. And if we divide EBIT by interest expense, we have a times interest earn ratio of 42.9. So what is this 42.9 number telling us? Well, in short, it's just the number of times over earnings can cover the interest payments. So earnings can cover the interest payments 42.9 times over. And this allows us to indirectly test the proportion of earnings consumed by interest. But the most benefit drawn is being able to test how comfortably the business can service its debts. And ultimately, you want the higher the ratio, the better. So 42.9 is better than 10.4 because it can more comfortably, 42.9 times over, cover the interest payments. Okay, just a quick review and a final warning. So we covered the leverage ratio analysis very briefly. It was just a short video. We looked at the debt ratio and the times interest earn ratio. And these ratios can be used to assess the financing strategy, debt serviceability, and thus financial risk. And just as a final warning, don't use a single ratio in isolation. Ratios are contextual. In other words, you have to use many of them and possibly other sources of data to get a true picture of the business. It can be a bit dangerous if you rely on a single ratio result without putting it in context. You must benchmark all ratio analysis. So one ratio result in itself may not be that useful. You should use time series analysis, where you compare the one ratio across time, or cross-sectional, where you compare one ratio against of one business against the same ratio of another business or multiple businesses. And don't forget that ratio results very often vary across industries. So it's important, if you are doing cross-sectional analysis, that you compare like ratios with like ratios. Okay, that's it. Thanks for your time. That's a very quick guide to leverage ratio analysis. Hope you can give me a thumbs up. Cheers.